No. No. Good afternoon, Mr. Prasad. It's a real pleasure having you here. I just wanted to do an audio check. Mr. Prasad, can you hear me properly? Good. That's good. Start in a minute. Hi, Darshan. Thank you. Hi, Mr. Sat. All right. So we're going to start the class today at a very interesting juncture in the markets. In the markets, you are now hearing a very constant refrain among all the fund managers and professional investors who are appearing on television that somehow because of the losses in the state elections, the central government is going to focus on the rural consumption theme, or is going to focus on rural consumption. It's going to give a large handout to the rural population. Sorry, just bear with me. And hence, the stocks that you should focus on are somehow the rural consumption stocks. And the stocks that they're talking about is Escorts, Maruti, the two-wheeler stocks, and of course, in the wake of the expected easing of RBI norms, the beaten down NBFC sector. Now, in this presentation, as you go through this presentation, you will learn that when you are investing in a theme, the idea is to buy the strongest stocks in the strongest sectors possible, or strongest stocks in the sectors that you think are going to outperform in the near future. So when somebody talks about Maruti or escorts or two-wheelers or non-banking financial stocks, because of the so-called government push, the expected government push into rural consumption, it reminds me of uh, or it possibly smells like somebody is underinvested in the markets and is somehow hoping to make up for that underinvestment going forward by investing in laggards. Why? Because Maruti, Escorts, all the auto packs, be it any kind of autos, commercial vehicles, uh, passenger vehicles, tractors, auto components, or forget about the NBCs, they've got trashed. But all the stocks that are commonly being touted as the biggest beneficiaries of the so-called or expected rural push by the government, they are the laggard stocks. They have massively underperformed in the current market correction that has taken hold, uh, even I would say starting in February 2018. So when somebody is touting those stocks, it smells like somebody is underinvested in the market and is somehow hoping to make up for that by latching onto the laggards. As you go through this presentation, you will understand that if you really believe that the central government is going to open the fiscal stimulus spigots, resulting in a revival in consumption growth, then counterintuitively, the best stocks to buy, if you truly believe in the consumption sector revival story, counterintuitively, the best stocks to buy will be Hindustan Lever and Titan. Now, please don't ask me how is Titan related to the rural push, because I don't know. I personally myself don't know. But if I take a big picture view, this is what I see. That in the consumption sector, if you club consumption staples and consumer staples and consumer discretionary, basically those sectors that will be benefited by the rural push, the so-called expected rural push, in these two sectors combined, these are the leading stocks: Hindustan Lever and Titan, leading consumption stocks and consumer discretionary stocks. Even Page Industries has underperformed miserably. You will learn in this presentation that the biggest irony in the markets is what the crowd thinks as too risky, too expensive, and something that has performed very well and therefore will not perform too well in the future. It is exactly those stocks that become more expensive that perform the best going forward. And it is those stocks where the crowd is picking up on those stocks because they have been the lagging stocks in that particular sector, in the hopes that they will play a catch up. It is in those stocks where 70% of the time you will face a massive disappointment. Another classic example of the same theory that I can give you is many a times you have the IT sector performing very well. And in certain situations, you would see that TCS performs very well, but Infosys somehow is not performing as well as TCS. So typically, you would see a lot of people, lot of even professional fund managers jumping onto Infosys in the hopes that it will play a catch up with TCS. In this presentation, you will learn that 70% of the time that's the wrong strategy. In the markets, what is strong always gets stronger. Laggards catching up is usually a strategy that works less than 30% of the time. So, with this, I would like to start the growth investing presentation, which will be in English today. And tomorrow I will take the same class. कल मैं ये क्लास हिंदी में लूंगा. तो ये क्लास आज मैं पूरी अंग्रेजी में लूंगा और कल यही क्लास अगर आपको हिंदी में देखना है तो कल आप आ सकते हैं सेम टाइम पे फॉर द सेशन इन हिंदी. Now, before I go to the actual class, I would request you to go to your web page and over there hover the mouse around your name until you get to this drop down menu, and please refer uh, us to your friends network, because we are still a very small organization. We need your help to grow, and without growth there is no survival. So please, if you want us to survive and continue to serve you in the future, please refer as much as you can to your friends and network. So if you go to this drop down menu and click on refer a friend, you will come down to this particular page, and you can, at the click of a button, refer us to all your network in these 4 platforms. And in return, you will get a 1 month extra access. Friend that you bring in, you will get 1 month extra access to Learn app free. Now, growth investing, obviously, as the name suggests, is looking at growth. But what kind of growth are we looking at? What is the growth of that we are looking at? We're obviously commonsensically looking at earnings growth. Now, the question is, there are so many different kinds of earnings that are thrown at you from various sources, be it television or be it the news, print media, and so on. Oh, I think the internet is hanged or what? Okay, now it's okay. So you would hear of quarterly growth, you would hear of annual earnings, you would hear of year-on-year earnings of a company in a particular quarter. You would also hear about earnings hit or miss with respect to analyst estimates. In fact, 90 to 95% of the time, if you are talking about earnings, or if you're hearing about earnings on the news channels or reading about them in the newspapers, you would probably be bombarded with whether information about whether the earnings have been in line with expectations or not. And at the very outset, I would like to tell you is that is the least important kind of earnings catalyst that you can look at. Forget about whether the earnings have beaten or whether they have underperformed expectations. That is not important. At the very outset, what I'm telling you is that what you are being bombarded with 95% of the time with regards to earnings, ignore that. For example, when ICICI Bank recorded its earnings or reported its earnings, it reported a 56% fall in year-on. Yes. And I got all sorts of research reports from all kinds of brokers advising me as to how great the results of ICICI Bank are and what a valuable company ICICI Bank is going to be, because it has reported only 56% fall in year-on-year, 56% year-on-year fall in profits in the most recent quarter. They were expecting a 90% fall or something like that, and it's reported only a 56% fall. Now, that's pure bullshit. Okay, irrespective of what the stock does, because it has met or outperformed analyst expectations, that's irrelevant. I will show you in this presentation exactly what is relevant, but uh, never be swayed ever again by sentences or guidance or advice like, oh, I was expecting this company to report 100 crores loss, but it has reported only a 25 crores loss, so everything looks hunky-dory. That's the sure shot path to disaster. Yes, there are certain instances whereby you can use that information purely to benefit from a trading pop for a few days or few weeks, which indeed the ICICI Bank stock did demonstrate such a trading pop. But from a long-term, lifetime kind of an investment, this particular kind of analysis is not only useless, but it can be downright dangerous to your financial health. Instead, instead, What is it that you should be looking at? So I'm going to talk about a framework that has not about, that has exactly 7 points in that framework. And the first and the most important point in that framework is year on year growth in the quarterly earnings in the most recent quarter. That is the most important statistic. So, what it means is, let's say that a company has reported a 56% year on year growth in its most recent quarterly result. And please remember, I'm talking about the year on year growth of the most recent quarter compared to the same quarter last year. So, year on year EPS growth is the number one point in our framework that you should look at in order to screen companies. Year on year EPS growth is the number one fundamental criteria in our screening list, whereby we will use it to screen companies and put those companies in a watch list from and from that watch list later on we will buy those companies at the appropriate time. So the hurdle rate in this case is 25%. What I mean by that is that you should actively search for those companies which have reported a year-on-year growth of 25% or higher in their EPS, in their earnings per share, in the most recent quarter. So if it has followed, if you find a company doing that, then you put it on the watch list. Then what? Second, you should also look at the year-on-year growth in the EPS in the previous quarter. So, for example, let's say in the September quarter, you found company A posting a 25% plus year-on-year EPS growth in the September quarterly results. So, because of that, you have put it on the watch list. Then what you should do is you should also look at the June quarterly results of the same company. So then you should look at whether the EPS growth in June 2018 versus June 2017, whether that growth is also 25%. Okay. Now, listen to me very carefully. What the market really appreciates and what the market really values is either that the earnings are growing in a very stable fashion at 25% plus or higher. So 25% is the bare minimum cutoff. Remember that. And if in a particular quarter you cannot find any company that has reported 25% plus YOY EPS growth, then don't worry. Keep your money in a liquid fund and wait for the right company to come by. Anyway, so you should look at the current quarter as well as the previous quarter and ensure that in both the quarters, the profit growth has been at least 25% or more. Okay. And here is something very important. The growth in the current quarter must be equal to or greater than the growth in the previous quarter. By this, what do I mean? I mean, for example, you find that a company in the previous quarter has enjoyed earnings growth of 30%, then you should also look for at least 30% growth in the current quarter or higher, because the market always values stable or accelerating year on year earnings growth, and the market severely punishes decelerating earnings growth. Because remember this, my friend, the market always looks at the change. The market is less concerned with the absolute number. It is always, markets and stock prices react to the change in the numbers. Okay, and that is why either the numbers, the growth should be accelerating or it should be stable from quarter to quarter. So for example, if you find company A reported 50% growth in the previous quarter and 60% growth in the current quarter, then that company is a company that you should definitely put in your watch list. Let's say You found another company which has reported 100% growth in the most recent quarter. Listen to me very carefully. In the most recent quarter, the company has reported 100% growth. Okay, so fantastic growth on the face of it. But when you go back to the previous quarter and you look, you see that the company has reported the EPS growth. Yes, Anurag, you're right. The year-on-year EPS growth of 150%. Okay, so previous quarter it reported 150% EPS growth, and in this quarter it has reported 100% EPS growth. Okay, just because in this quarter the 100% number looks very high, it doesn't mean that the market is going to like the results. The market is, in fact, more often than not going to severely punish the company that reports such a huge deceleration in its quarterly or sorry in its EPS growth. And again, please let me remind you, I'm talking about year-on-year EPS growth. I'm not talking about quarter-on-quarter EPS growth. Many a times you will be confused and look at the quarter-on-quarter EPS growth. So never compare the growth of the September quarter to the growth of the previous June quarter. No, don't do that. That's useless. That information is completely useless because of seasonality. It doesn't help you at all. What you should be comparing is because you should compare September 2018 to September 2017. You should compare June 2018 to the growth, and you should look at the growth of June 2018 to the versus the June 2017 quarter. Okay, so this is the first point in the framework whereby you're looking at a minimum hurdle rate of 25%. On top of that, you are looking for 2 quarter. I haven't looked at Avanti Seeds, but you may be right. Long time back when I had looked at Avanti Seeds, I saw this massive deceleration coming through. In fact, there are so many consumer companies, Mr. Arora, which are showing this deceleration. In fact, that leads me to believe that over the last 3-4 quarters, thanks to the base effect of demonetization, the companies were reporting very high year-on-year growth in their quarterly numbers. But now that the base effect of demonetization is slowly, no longer relevant, now the real structural growth of the companies is actually coming through in their quarterly results. And it's not a pretty picture. Look at the earnings growth of Page Industries. It's shocking. Look at how Kajaria Industries earnings growth is decelerating. So many erstwhile high-flying companies. I think Whirlpool could be one example, if I'm not badly mistaken. Voltas could be another example. Even Titan, for that matter. Great revenue growth, but again, the earnings growth is, very, very, it's slowed down. So I don't know what's happening with Avanti Seeds recently, but yes, I have seen a couple of very high-flying companies show a massive deceleration in their earnings growth, which is not a red flag at the moment because it's just 1 quarter, but it's definitely raising a yellow flag to my mind in these erstwhile high-flying companies. So you can look at Avanti Seeds and use this particular framework and figure out whether the earnings are accelerating or decelerating quarter on quarter. So the example that you have on your screen is that of Jockey, which is basically Page Industries. So in 2008, 2009, the example that I want to give you is 2008, 2009, when the entire world was collapsing. Jockey was reporting phenomenal earnings growth of 31% in EPS and 33% in EPS growth and 38% in EPS growth. So far higher than the 25% handle or the hurdle rate. So obviously Jockey, once that bear market passed over, Jockey became one of the best performing stocks in the next secular bull market that started from March 2009. So I think what Jockey was, I think 500 rupees, and then it went to 35,000 rupees. But you got a clue about that from analyzing a very simple statistic, which I don't know why they don't teach you on TV, but very simple statistic, which is year-on-year EPS growth for the past several quarters. It should be higher than 25%, and it should not be decelerating. It should be stable or accelerating. Okay. Also, you also need to understand that earnings growth will ultimately happen because sales is growing. Okay. Margin expansion cannot forever lead to earnings growth. So if you have two companies whereby one company, the earnings is growing because of sales growth, versus the other company, which is where you see that the sales are a bit tepid, but because of margin expansion, the earnings are growing above the hurdle rate. Then obviously you should choose or favor the company where the sales growth is also 25% plus, because that is a company which will be able to sustain its earnings for a longer duration. So the second point in this framework is look for companies whereby the revenue is also growing by 20 to 25% or more year on year every quarter for the last, at least for the last 2 quarters. Now, another example that I can think of is Aisha, whereby in June 2009, Aisha reported, I think, so if you look at this, the EPS in June 2009 was 7.35 rupees versus EPS of 1.88 in June 2008. I just can't even, I mean, that's like an explosive. It's forget about the 25% hurdle rate. It's like an explosive earnings growth. So that's the first clue you will get that a company is probably about to start on a stellar bull run. And you should definitely put companies like iShare and Page Industries in those times. I'm not talking about today. I'm talking about June 2008, 2009. Uh, this would give you the first clue about the fact that these are quality companies, quality growth companies, which can massively give you massive multi-bagger returns if you buy and hold them for 10 years or so, 5 to 10 years. Now, as a gentleman pointed about Avanti Seeds, I haven't looked at Avanti, but I have definitely looked at DMart. And what I have looked at, I don't like, because you see that even though DMart is reporting decent growth in revenues as well as earnings every quarter, the growth is itself decelerating. So, my friends, always remember the market is bothered about change. The market does not care about absolute numbers. If the change is positive, the market is very happy and it rewards such stocks very handsomely. And if the change is negative, the market does not bother and it punishes those stocks. It does not bother about management quality or anything else. If the change is negative, those stocks more often than not get hammered very badly. So it's not without reason that ever since the September 2018 results came out, DMart has not been performing up to the mark. The stock price, I mean. Also, one thing that will also help you to improve your batting average is, as I said, you should always favor companies where the promoter or the management is focusing on increasing earnings growth through sales growth. Okay. And you should consider those companies over those companies where the management is too focused on margins growth. Like one company that comes to mind is often the multinational companies. They often focus more on profitability and margins rather than sales growth. Anyway, the point that I want to make with the slides is, if you get a company where the management is focused on revenue growth to increase the EPS growth, on top of that the management is also has a strategy, has a product strategy which allows it to keep maintain or slowly increase its margins, then that company is like a double whammy on the positive side. So you get a double positive whammy with such companies. So your batting average will improve even more if you can find companies where there is revenue growth, there is earnings growth, and to top it all, you have stable or increasing margins. Okay, the chat has disappeared from YouTube. My friends, please bear with me. I want to get the chat. Why I'm not getting the chat? Uh, Maybe it's an internet problem. Just bear with me. Okay. Okay, so I'm back. The chat is back. Let me just check my internet. It looks like there's a problem in the internet. It's okay. All right, Gagan, Anurag, is everything all right? Have you been able to hear me properly? I just want to do a tech check. The slide I can see it's there back on the YouTube. Is everything all right in terms of being able to see the PPT and hear me properly? Yes. Okay. Thank you. All right. All right. Thank you. Perfect. So, by now we have seen, we have analyzed the quarterly results, and we are going to focus on companies where they have reported at least a 25% growth in sales, at least a 25% growth in earnings per share, and if possible, uh, a, s- a stable and increasing, a stable or increasing margins. But most importantly, these growth numbers should either be stable across quarters or they should be accelerating. So this is the way we analyze the quarterly results. And please remember, do not get confused by QOQ growth. Do not look at QOQ growth. Sometimes QOQ growth is important, but uh, at the beginning, at the outset, when you are starting out, don't worry too much about QOQ growth. It can be very misleading unless you have a deep understanding of the company business. Okay, so focus on year-on-year EPS growth. Trust me, that's all you need. All right. So, in order to ensure that the year-on-year EPS growth that you see in the most two recent quarters is just not a one-off, and that the company is actually a stable quality growth company, you should also look at the annual earnings. Annual earnings should also grow at 25%. Annual earnings means annual EPS every year, so we're at 25% plus. And the annual revenue should also be growing at 20% plus or higher. Here again, you should also focus on the stability of the earnings. So, when I'm saying that you should look at 25% growth in annual numbers, firstly, you should look at 3 years of annual numbers. So, over a period of 3 years, the company should have reported 25% growth in EPS and sales every year. Now, the question here is, what if the company, instead of reporting a steady 25% growth every year, what if the company has a kind of a earnings growth, something like this? So in the first year, it reports 25% growth. Second year, the growth falls to 10%. And in the third year, somehow it goes back up to 45%. So if you add these three numbers, you will get to roughly a 25% CAGR growth. So is that okay? The answer to that question is no, it's not okay. You are looking to buy quality growth companies that you are intending to buy and keep for the next 5-10 years. Everything should fall in place perfectly before you invest a dime into that company. Else, you know what you should do? You should give your money in a good index fund or a good, well diversified mid cap equity fund in order to stay invested in equities. But when you're investing your own money using your own framework, your own brains, where all the risk is yours and where you cannot really blame anybody else for the mistakes, then you should have everything fall in place together before you invest a dime. And that is why even in the annual earnings, we require stability, which means I am not okay with just a 25% CAGR growth. So I want 25% growth every year like clockwork. So 25% growth in first year, 25% growth in second year, 25% growth in third year as well. And both the sales growth and the EPS growth. Sales, you can take 20%, but EPS, I would suggest at least 25% growth you should look for. Now I come to a very, very important hurdle that you should never ignore. In fact, I have seen from experience that sometimes you may give leeway on the sales growth. Sometimes instead of 20% sales growth, you might settle for a 17-18% sales growth kind of a number. Sometimes instead of a 25% EPS growth, you may settle for, let's say, a 19-20% kind of an EPS growth. But there is one hurdle that you should never compromise upon, because if you do so at a great peril to your own financial health. And that hurdle is return on equity, which is calculated on an annualized basis. So at every year, at the end of the year, the company reports its annual results, and based on this annual results, you need to calculate the return on equity, and that return on equity should be at a minimum 18% or higher. In fact, I would say that it should be something like 18% for large caps and 20% or higher for mid caps, and probably even higher hurdle rate for small caps. Okay, so 18% for large caps, 20% for mid caps, and maybe something like 22% for the small caps. And it is this criteria on which you should never compromise, never, never, ever compromise. You may compromise to some extent on the growth criteria, but please do not compromise on the return on equity criteria, because you know that all the time you get all these people come on TV and talk about buy quality management, quality stocks, blah, blah, blah. You want, but nobody actually tells you a quantitative way to figure out what is quality management. Okay, quality management, the number one criteria is return on equity. The most important criteria is return on equity. In fact, if you want to make it even more complicated, it is return on invested capital, but forget that. For you, for starters, look at return on equity. Okay, so return on equity is the biggest uh, clue that you have invested with a quality management. You have invested in a company which probably has a clean management, and most importantly, you are invested in a company whose product and market strategy is such that it allows the company to earn a very decent return on capital as compared to its cost of capital. There are so many high flying banks that people are coming on TV and touting as the next best investment. Like everybody is talking about corporate banks, ICICI Bank and Axis Bank. Do you know what is the standalone return on equity of ICICI Bank? If I'm not badly mistaken, the standalone, I'm not talking about the consolidated return on equity. Consolidated return on equity will always be very good because of the consolidation of great subsidiaries like the life insurance and general insurance. But if you look at the standalone return on equity of ICICI Bank, if I'm not badly mistaken, on a trailing basis, it is less than 4%. Can you imagine that? And today, every Tom, Dick, and Harry comes on TV and tells you that ICICI Bank is one of the best investments. I would humbly beg to differ. I would humbly beg to differ. Of course, at this juncture, there are many value investors and great value investors at that who will tell you that, you know what, the way to make multi bagger return is to invest in a company with a current low return on equity, but where you expect the return on equity will improve drastically in the future. Because if that happens, you will not only make a lot of money because EPS is growing, but also because the return on equity is growing, your valuation of the company will go up. So you will get a kicker. But I would, at this point, I would say that is the basic difference between growth investing and value investing. In growth investing, there is no imagination involved. There is no thinking that this company may do this in the future. In growth investing, I want proof of concept today. Is it clear? I want to see a high return on equity today. Yes, you may be a great management that can take the ICICI Bank's return on equity from 3% to 30%, but I am not bothered. As a growth investor, I am going to invest in companies like Bajaj Finance, which are already showing me, which are already showing me 20% plus return on equity. I'm not going to touch ICICI Bank with a barge pole. I'm going to leave that to the great value investors of the day. Okay. That is how growth investing differs from value investing, because in growth investing, it is pure hardcore numbers as you see them today, right now. There is no imagination involved or necessary. There's no imagination necessary. All right. So, what happens if you invest in a company where the return on equity is not up to the mark? You end up in disaster. For the last 3 years, the return on equity of DHFL was 14%. Uh, uh, and this is just an aberration because of extraordinary gains. But if you take out the extraordinary gains, DHFL's return on equity for the last 3 years was 14%. So it is very, very obvious. See, ultimately, my friends, understand this. In India, if you put your money in a debt fund, okay, if you put your money in a debt fund, almost on a risk free basis, you will make 9 to 10%. Okay, 9 to 10% on a risk free basis, you will make if you put your money in a debt fund. Yeah, on a long term horizon. I'm talking about a 10-year view. So if a company's return on equity is just 14%, okay, so basically, if debt is giving me 9%, then if I'm talking about the high quality large caps, then the hurdle rate in the high quality large caps, or the so-called cost of equity in the large caps, will be something like 13-14%. Okay, so if I'm talking about a mid cap which is earning 14% return on equity, it means that it is earning less than its cost of equity. You can get away with it with doing that for 1 or maybe 6 months, 1 year or to 6 months, but you keep doing that for 3-4 years at a stretch. Ultimately, the market will punish you very badly for that, because ultimately, what is the gain in the stock price is equal to? In the long term, it is nothing but the return in equity in excess of the cost of equity. That is what drives stock prices. So if your return on equity is consistently below the cost of equity, at a certain point, the market will also say enough is enough. Now, let me thrash you to hell. Okay, so be very careful. Do not compromise on the return on equity. So, Gagan has a very interesting question. Is it not better to invest in value compared to growth? Well, it depends on what kind of nerve do you have, what is your basic instinct. Because value investing requires a very different skill set, a very different mindset to growth investing. In growth investing, I'll tell you what is the biggest problem in value investing. In value investing, the biggest problem is that you cannot apply the concept of a stop loss. Because if a company uh, looked very good at 100 rupees as a value investing proposition, then if the company goes to 60 rupees, then it would look even better. And there have been so many public sector banks that have done exactly that. PNB went from 150 to 60. So on a value basis, if you liked PNB at 150, you should be jumping for joy when PNB is at 60. And it's very well possible that people who bought PNB at 150 and then average down at 60 will make a humongous amount of money over the next 10 years in PNB. I don't know whether that will happen or not, but it's possible. But it requires a very different mindset and a very different skill set and the ability to really go against the crowd and keep adding on to your loser. Okay, value investing requires is very different from growth investing in that crucial way. Value investing requires you to keep adding on to your loser if you have the conviction. Okay, you can't say that, oh, I have bought a stock at 100 and I'm going to take a stop loss at 90. That is not value investing. That is just some kind of investing that has no real title or label, that can't be labeled. Growth investing, on the other hand, the benefit of growth investing, as you will see, is firstly you're getting proof of concept. And as long as earnings are accelerating from quarter on quarter, every quarter, you will see that the stock performance will also perform. As at the very beginning of the presentation, as I said, in the market, the irony is strong gets stronger and the weak gets weaker. Hindustan Lever is becoming more and more expensive every day, and yet it keeps going up. At the same time, Tata Motors is getting cheaper and cheaper every day, and it keeps going down. Okay, it depends now what kind of an investor you are. If you're a growth investor, you would focus on Hindustan Lever. If you're a value investor, you would focus on Tata Motors. The Indian market per se is a growth investing kind of a market, whereby I think more often than not, growth investing is the right strategy. Value investing can be a very, very good strategy in cyclical stocks like Tata Motors, like Vedanta, or like ACC, and that I will teach you next week. But most of the time, growth investing works better in India. So another way to answer your question, Mr. Arora, is what if you're wrong about the margin of safety? People thought they had a great margin of safety when PNB was at 90, and from there the stock went to 60. What do you do then? So that is the problem. All right, so now I have given you the fundamental criteria based on quarterly and annual results. I will now help you out by telling you where to focus your attention. You should focus your attention on those stocks that have listed over the last 5 years. That is where you will get your next best thing. Look, Bajaj Finance, Page Industries, HDFC Bank, they are also probably going to grow their earnings per share 25% plus, and sales growth of 20% plus, and so on, with a very high return on equity. But all that is more or less discounted in the prices. You will not have HDFC becoming doubling or tripling within the next 3 years. Okay, that is not uh, possible. It's probable but highly unlikely. But if you focus your stocks, typically, stocks that have been listed over the last 5 years, that's where the market is not paying too much attention. And that's when, if you focus on those stocks and figure out those companies where you are seeing these characteristics of high return on equity, high sales growth, high profit growth, and if possible, margins that are stable or increasing, then believe me, you have found a company where investing in that company can give you returns like Page Industries did in 2008. If you invested in Page Industries in 2008, 2009. In fact, Page Industries was listed, if I'm not badly mistaken, Page Industries was listed in 2007 April. Okay. Uh, and in 2008, 2009, if you had bought Page Industries at 500, then say 2008, nobody would have had the courage to buy anything. So say 2009, when Page Industries made a new high, let's say you bought Page Industries at 500 rupees, just imagine the amount of money you would have made. And Page Industries was listed in March 2007. So those stocks which have listed over the last 5 years is the most fertile ground, because you see, my friends, you don't need to pick 20, 30 stocks. You need to find 5 or 6 stocks that are meeting these criteria and which have not yet been discovered or too much discovered by the market, so to speak. And the best ground for that is newly listed stocks. So Bandhan Bank could be one such example. Now, I've told you by now all the fundamental criteria that you can use to shortlist your stocks. I have also told you where to look for those stocks. Now I will come to technicals. Why? Because our approach is not just about buying quality stocks, but it is also about buying quality stocks at the right time. You must have heard of Warren Buffett and many other investors come on TV and give you this a common phrase that buy when there is a massive fear and sell when there is massive greed. You know what is the irony of the markets? The irony of the markets is that fear is at its maximum in a particular stock when the stock is making new highs. Greed is at a maximum in a particular stock when the stock is making 52-week lows or all-time lows. When a stock is making all-time lows, 52-week lows, everybody thinks isse niche aur kya jayega? How much lower can it go? Okay, everybody wants to pounce and buy Yes Bank, Punjab National Bank, DHFL. Everybody comes up to me and say, "Oh ho, look how smart I am. I bought DHFL at 150 and I exited at 190. I'm such a smart investor." I would say that you are a dumb, lucky investor. That's all you are, but that's my humble opinion. Don't take offense. Uh, anyway, people get extremely greedy when they see stocks that have been high flying in the recent past. When they see those stocks falling very badly, they think, no, no, no. If I buy at these stocks 40-50% lower, I'm pretty sure within the next 3 or 4 days, I'm just exaggerating, within the next 3 or 4 weeks, I will make that 40-50% back. Or not 40-50%. If a stock has fallen 40%, then it has to go up like 60-70%. So within 3 or 4 weeks, I will make 60-70%, if I buy the stock. This is what is called the recency bias. If you have seen something trade at 100 rupees and that falls to 60 rupees, so people suddenly start, daydreaming. Oh, this is such a great stock. This is a great time to buy. And that is why, my friends, always remember, greed is at its maximum when the stock is down 30-40% from its lows, at its 52-week lows, at its all-time lows. That is when this mentality, and it's not just retail investors like you and me, even fund managers, even hedge fund managers think like that. And that is why you have all those Tom, Dick, and Harry come on TV for the last 2 days, telling you, oh, that Escorts will be the best stock to buy, Maruti will be a good stock to buy, oh, two-wheeler stocks will be a good stocks to buy. Why? Because these stocks have fallen 40%. And that's the only logic. If you dig deeper, if you scratch a bit deeper into their logic, that is probably the most important criteria as to why they are suggesting the stocks. And yet, as I'm telling you, if you want to really play the theme of consumption sector for the next 6 months, the stock to buy will be Titan and Hindustan Lever. Please don't ask me how Titan or how Hindustan Lever is linked to rural. All that I know is Titan is ruling very close to its all-time high. All that I know is that Hindustan Lever is ruling at its all-time high. So if you want to play consumption sector properly in a really smart way, buy Hindustan Lever or Titan. Just for as a disclaimer, I do not believe in that consumption sector hypothesis. But if you do and you want to play that, you buy Hindustan Lever and you buy Titan. Because why? Fear is maximum in Hindustan Lever. Fear is maximum in Titan. यहाँ से और कितना चलेगा? इतना तो चल गया. लो से तो इतना ऊपर आ गया है. यहाँ से और कितना चलेगा? And yet, ironically, over the next 6 months, if indeed consumption sector performs, I can bet that with a probability of 70%, I will tell you shortly why I'm saying 70%. 70% chance that Hindustan Lever and Titan will outperform Maruti, Escort, Hero Honda, or whatever you can think of. Okay, why? Because at 52-week highs or all-time highs, everybody is scared. They are scared to death. They want to protect their profits. Yahan se aur kitna chalega? Okay. And that is the irony. And if you want to make big money, what you should basically do is look for quality stocks. And what do I mean by quality? I'm not talking about, I really get irritated when people come and say on TV quality stocks, quality management, and then they don't bother to define it. Anyway, that's a different story. I have given you the definitions. If you're looking at quality management, look for high return on equity. And if you're looking for quality growth stocks, you look for high EPS growth, high sales growth, good margins, and you should also look for accelerating. Always look for stocks where the EPS growth is accelerating from quarter to quarter, over every quarter. Okay, and if you find some these companies making all-time highs, that is When the company makes all-time highs, that's when you buy. And this is exactly what happened in 2008, whereby Page Industries was showing all those good results, and everybody was scared to buy because of the great recession and the depression. But ultimately, when Page Industries broke its all-time high, I think what's the price here? Yeah, 500 rupees. If you had bought Page Industries, I mean, you can just imagine how much money you would have made. If you had bought 100 shares of Page Industries for 50,000 rupees, you can just count how much you would have made by now. So this is when TCS made an all-time high. See what happened after that. So that is the basic thing that, my friends, you should remember, that uh, people are really, really scared at all-time highs. And if you really want to follow Warren Buffett, you should buy all-time highs, because that is when people are most scared. People are most greedy when the stock is down 40-50% from its recent highs. I like, everybody is jumping up and down on the TV. Everybody is too bothered about Yes Bank, what to do about Yes Bank, what to do about DHFL. Nobody cares about stocks, or nobody talks about stocks which makes new highs. The moment it makes new highs, you will have fundamental analysts and coming on TV and saying, "Oh, it's very expensive. It's time to book your profits." Anyway, now let's look at this example, whereby I am showing you this example because sometimes buying all-time highs does not work, like it did not work in case of Mindtree. So Mindtree was showing excellent fundamentals. So if you had bought this stock here when it broke its all-time highs, because the fundamental picture was very, very good, you would have suffered a pretty nasty loss. Now, this nasty loss is because of the fact that even though the Mindtree came up with good numbers, the management came out with very bad guidance for the future, and therefore you had a pretty nasty shock here. Now, in order to safeguard against such hiccups, this framework that I have been teaching you also has the concept of a stop loss. So typically what you should do is, let's say you bought the all-time high. So this is where, if you had bought the all-time highs, you're absolutely correct. Look, in the market, always remember that the market is such an evil animal that it does not always reward you for doing the right things the right way. And it is such an evil animal that many a times it rewards you for doing all the wrong kind of things. And then when you start thinking that you are very, very smart and invest all your money, that's when the market comes in and whips you into bankruptcy. Okay, so don't be disheartened if you have a case like this. Market does not always reward you for doing the right things the right way all the time, but 70% of the time the market rewards you for doing the right things the right way. So in order to safeguard against this, you should have a reasonable stop loss. Now if you know a bit of technical analysis, basically you will see that this is forming a kind of a range out here before it broke out to new highs. And that's important. You should not be chasing new highs. You should be looking for a break of a consolidation range. So here it was the perfect break of a consolidation range. If you know a bit of technicals, you will see that the midpoint of the technical of that particular range is a very good stop loss zone. Okay, so the breakout happened around 1100 rupees, and the midpoint was around 1000 or 995 rupees. So you should have bought the stock at 1100 with a stop loss of 995. So it is absolutely essential to buy, or when you buy the stocks, to have a predetermined stop loss. If you don't know technical analysis, you can have a predetermined stop loss depending upon the capitalization. So if you're looking at, say, a large cap stocks, you can have a 10% or a 12% for mid caps and 15% for small caps. You can have that kind of an arbitrary hard stop loss. Or if you know a bit of technical analysis, you can have you can do your technical analysis, and you can put the midpoint of the consolidation range as the stop loss. Now the question is which time frame. I prefer the weekly time frame. Okay, so when you're looking at breakouts into all-time highs, you would typically want to look at least weekly time frame. Okay, because weekly time charts, because many a times on the daily charts you would have stock making an all-time high, but very soon thereafter it comes back inside and below its all-time highs. So always you want to look at all-time highs at the in the weekly charts, and if you want to be completely safe, then you want to look at the a stock making all-time highs on the monthly charts. Even on the monthly charts, even if it might be slightly late, but of course there is always this trade-off between being slightly late between and safety. So monthly charts will get you into your stock slightly late, but it's an absolute safe and sure shot indication that the stock has broken out. If you want to play it slightly risky, not too risky, I would say, but slightly riskier, you can use the weekly charts all-time high breakout, but never use the daily charts. Okay. So that is the. I hope I have answered your question. So with this, my framework is correct. So as I said, so here at the midpoint, you would place your stop loss, and as soon as the stop loss was hit on an intraday basis or a daily basis, whatever, you got out. So the stop loss you have to monitor on a daily basis. That is not a weekly basis. So or even on an intraday basis. So you buy on the weekly chart all-time high breakout at 1100. You keep a stop loss at 995 or I think 1000, and the moment anytime intraday or a daily or a weekly basis it breaks that, you are out of the stock. And again, suppose the stock just reverses after hitting a stop loss and makes another all-time high, then please do not have ego, buy into that stock, because you're after all buying a quality growth stocks which is kind of teasing you a bit but ultimately will work out very well in the long term. In fact, look at this chart. This is the chart of a cyclical stock, which many you could have purchased just based on the fact that it broke its all-time highs. Okay, once it broke it, this is the monthly charts. Yeah, this is HEG, a cyclical stock which broke its all-time highs. In fact, if you want to if you're a bit systematic driven trader, one of the systems that you can explore is buying a portfolio of stocks, or let's say you have 100 rupees. So anytime a stock makes a new all-time high on the monthly charts, you put 2% of your portfolio into that particular stock, 2 to 5% of your portfolio into that particular stock. This system, by itself is a very good system. Why is it a very good system? Because as I said, at all-time highs, everybody is scared shitless. And at all-time lows or 52-week lows, everybody is a tiger. Okay, so with that, I want to put this as the last slide. Now, I've kept telling you that there is a 70% chance that if you buy, the leaders, the strong stocks, if you buy Hindustan Lever or Titan, there is a 70% chance that you will make more money than if you buy the laggards like Maruti or Escorts, provided you believe in that consumption theme. Now, where did I come up with the 70% number? I came up with the 70% number from this gentleman who is Steve Cohen. Steve Cohen is a multi-billionaire himself, and he runs the world's largest, stock hedge fund. So he is basically known in the world for being an excellent stock picker. Forget about Warren Buffett. Steve Cohen is an excellent stock picker. Why? Because Steve Cohen, whenever he picks a stock, at least within the next 3 months, the stock will go up by 50-60%. So his annualized, so the hedge fund that he has, he charges an extremely high fee, and yet there is a long waiting list of investors waiting to invest with him. Anyway, now this stock picker, somebody who is picking stocks purely on a fundamental basis, let us see what he is saying. He is saying 40% of a stock's price movement is due to the market. 30% is due to the sector and only 30% due to the stock itself, which is something that I believe in. Okay, so he is saying that 70% of a stock price's movement is because the market is strong and the sector is strong, and only 30% is due to the stock itself. So basically, it's another way of saying that the strong gets stronger and the weak gets weaker. And that is why, my friends, whenever you have a choice of two stocks which are both showing very high quality growth characteristics, which I have explained to you in terms of annual and quarterly results, always choose that stock where the sector itself is also showing strength. So, for example, right now, if I might say, the sector that is showing the best strength from a 12-month perspective. I'm not talking about the most recent month or most recent quarter, but over the 12-month perspective, the strongest sector has been IT, even though there has been a fair bit of correction in IT stocks over the last month. But over a 12-month period, IT has been the strongest sector. And one of the weakest sectors has been auto, which is the any kind of auto. Forget about Tata Motors, even Maruti has performed very horribly. So let's say tomorrow you get two stocks, one of which is an auto stock, say a Maruti, and you get another stock in IT called TCS. And both of these stocks are showing, uh, very good fundamental characteristics. But Maruti belongs to a sector that has been really performing badly over the last 12 months, whereas TCS belongs to a sector which has been a star performer over the last 12 months. Which stock should you buy? The answer is very clearly and very easily TCS. Why? Because it is very unlikely that a single stock will break away from the sector and completely go against what the sector is doing. It is almost next to impossible. It is not 100% impossible, but almost next to impossible. So even if you get a breakout in Maruti, more often than not, like Mindtree, like the example of Mindtree, that breakout is going to hand you a stop loss. Okay, whereas the breakout in TCS is probably going to be very, very successful. Why? Primarily because TCS belongs to a strong sector, whereas Maruti belongs to a weak sector. So, despite Maruti's fundamentals being equally good compared to TCS, because the sector is weak, it pulls back and pulls down on Maruti again and again and again. Why do you think? Why do you think that Axis Bank and ICICI Bank just keep hitting all-time highs and retreating from there? Okay, let us for a moment accept the value investing proposition that bhaiya, over the next 3 to 6 months, corporates are going to come back in a big way. They're going to invest in India. It's going to be India shining all the way, and therefore corporate banks are going to do very, very well. If you if you accept that theory, why is ICICI Bank and Axis Bank constantly hitting all-time highs and falling back? Why? Why are they giving you so many stop losses? Because the sector itself is weak. The banking NBFC sector itself is currently in a very weak place. It is very difficult in such a situation for just two stocks, no matter how good the story may be, to just break out and go against the sector. Okay, so remember this: strong gets stronger. And on the other hand, for example, apart from IT, one of the sectors that have performed very, very well over the last 12 months is FMCG. So buy Hindustan Lever, no problem. The stock is also good, the sector is also good. Okay, so again, here is a real life example. Hindustan Lever fundamentals are great, and you think ICICI Bank will fundamentals will become great because of corporate revival. Which stocks, and both of them are have broken all-time highs. Okay, look at the charts. Both of them have broken all-time highs. But ICICI Bank belongs to a banking sector where there is a lot of flux, lot of unresolved issues still, and the stocks are performing. The sector itself is not performed very well, versus FMCG sector, which has cleanly outperformed the market over the past 12 months. Which stock will you buy? Obviously, Hindustan Lever. Because if you buy Hindustan Lever, the chance that you will be stopped out is very, very remote. Okay. So you basically look at the last 12-month performance of every sector. You go to the BSE website. So BSE has given you so many sector indices. So you go to the BSE website and download the data from there, the price index data, and you will immediately be able to compare the 12-month performance of each and every sector. And it will give you that which sectors have been the best performers over the last 12 months. And primarily be focused on those breakouts. See, there are many stocks with good fundamentals from many sectors that will be breaking out, but you have to choose those stocks where the sector has been a clean performer, or else you will get constantly stop lossed out. For the last 6 months, Axis Bank and ICICI Bank have been completely frustrating anybody who has been trying to buy them at all-time highs. They're making all-time highs and immediately giving a stop loss. Okay, so at this point, I would end the presentation and throw the floor open to questions. While I do that, let me just quickly check at Avanti Seeds quarterly results uh, and see what's happening there. Thanks, Darshan. Yeah, Darshan is absolutely correct. You should go to valueresearchonline.com and type in the company name in the search field, the search box, and immediately you will come to the company page and you will get all the data arranged very well. So I was looking at Avanti, and as suspected, there has been a massive deceleration in earnings over the last few quarters, and as a result, the stock has fallen quite a lot from 1,000 rupees. Wow, it has fallen from 1,000 rupees to 300 to almost 350 rupees. Now, actually, there is one more thing when I look at Avanti that I forgot to, that I should have probably told you, which is you got into a stock, you understood all the fundamental criteria, you bought at all-time highs, you followed the stop loss criteria and all that. The thing is, irrespective of how good or how good the company numbers are, how good the management or the product is, you should always have a stop loss, be it a fixed arbitrary stop loss of 10%, 12%, or 15%, or a decent technical stop loss. You should always have a stop loss. Okay, so even in Avanti fields, I mean, a true growth investor wouldn't be too bothered by this fall from 1050 to 350, because he would have had a stop loss, and once he's making profit he would have a good stop win plan also. What is a stop win plan? So just as I said that technically you should look at the logical stop loss points. So once the stock is up 20-30% from your buy point, then you can start looking at technical zones where which are logical areas of supports and resistances. Okay, so those technical areas where there is a logical support, the stock must not fall below those support zones. If it does, you should immediately get out of those stock. Okay, So please listen to me very carefully, because this is about managing your profits. So you have bought into a stock. The stock has given you a pretty decent return of 20-30% within 3 or 4 months. Once that happens, you should immediately start watching for logical support areas where the stock must not breach those logical support areas. And the moment those logical support areas are breached, you should immediately exit the stock, irrespective of fundamentals, irrespective of management quality, irrespective of products, irrespective of any story anybody is telling you, whether on the news channel or the newspapers or your broker. Okay, so this is how you should manage your profits. So the chat is again disappeared. Let me try and get it back. Oh, there is a problem in my internet. Friends, are you able to hear me? Because I'm not able to see the chat. Uh, Let me refresh my YouTube. Yeah, 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 yeah. Okay, now I got the chat back. Fine. Okay, so stop loss midpoint from breakout level. Yeah, yeah. Basically, see, Mr. Sat, uh, it would help if you know some basic technical analysis, but uh, see, look at any chart. So you are looking at consolidation levels. It would be very good if you can get, logical support levels, that the stock is making when the when the stock is breaking out. What I would suggest everybody should do as an exercise right now is go to www.investing.com. Okay, I have a chart, I think. Let me see. Okay, so this chart is of the mid cap index. Okay, so Mr. Sat, what you should do, is mark the logical support and resistance levels. So when the stock market is going up like this, okay, and then it takes a breather, and then again it starts going up. So the lowest point of the breather, so here, that becomes a logical support level. So this is a logical support level. This is another logical support level. This is another logical support level. Okay, again you might say that this probably is a logical support level. This is not very clear, but okay, let's say that this is a logical support level. Okay, so these support levels should not break. The moment this support level has broken, you should be out, which means, for example, in case of the Nifty mid cap index, the moment this support level was broken here on a month, this is a monthly chart, so on a monthly basis, closing basis, you should be out of mid caps. Okay, and when should you get back? So again, just as uh, the lowest points are support levels, the highest points are resistance levels. So when the market is falling and then it recovers a bit and then it starts falling again, so these are your resistance levels. So this is again a resistance level, and again here this is a resistance level. So the moment on a monthly closing basis this resistance is taken out, you would say that the market is again in an uptrend. So this is how you can manage your position. So you buy once the position starts showing a decent amount of profit, you are you are going to basically monitor support and resistance levels. Mr. Prasad, excellent question. Very, very good question. I thank you for asking me that question. Uh, Price to earnings or price to book value or any kind of valuation ratios are completely irrelevant to growth investing. The only thing that is relevant to growth investing is accelerating earnings and revenue growth every quarter and a very high return on equity. Because if you look at Amazon, for example, Amazon has been trading at triple digit price to earnings multiple for a very, very long time. And yet it has been one of the best performers over the last 3, 4 years. So if you uh, basically disregard a growth stock because it is sporting a very high price to earnings multiple, then you will miss out on so many good stocks like Amazon, Google, or Alibaba for that matter. So never ever go by price to earnings multiple. See, our formula is very simple. Look for good quality stocks with quality management that are making all-time highs. And once you have made a decent amount of profit, you manage it using support and resistance levels. Manage your profit using logical, commonsensical support and resistance levels. Our framework is so simple. And unlike TV commentators, we are defining quality very quantitatively. We are defining quality growth very quantitatively. We are defining quality management very quantitatively. There is no scope at all for your imagination or your hypothesis. Everything is quantified and available right in front of your eyes in terms of fundamental information. And once that fundamental information is in your hands, you immediately buy an all-time high breakout with obviously a reasonable logical stop loss. Okay. And once after you have purchased, you have made a decent amount of money. And by decent, I mean 20% in a large cap, 30% in a 30 to 40% in a mid cap, and 50 to 60% in a small cap. Then you start monitoring the support and resistance levels. So Swaroop, when should we start booking profits? Obviously your support and resistance level will automatically take you out of your stock. Okay, so it's an automatic technical way of getting out of your stock. So you don't have to look at uh, any other thing other than the support and resistance level. The only fundamental information that may inform you as to now the support and resistances are going to break is exactly what has happened in Avanti Feeds, exactly what has happened in Page Industries, which is deceleration, exactly which has happened in DMart, which is deceleration of year-on-year EPS growth over the last several quarters. So you will get an advance notice that, boss, now this support is mostly going to break, and the moment it breaks the support, you are out of that stock, because you're fundamentally it's a bad, your information is bad, and technically also it has given you a red flag. So fundamental becomes your yellow sign, and technical is your final red sign. You're completely out of the stock. Again, it's Avanti Feeds is looking very, very interesting to me, because there has been some, when I looked at the charts of Avanti Feeds, there has been a massive white candle that I'm seeing, whereby the stock went from what, 334 to 368.8 in in a very in what, 3 days time. But again, if you're planning to buy Avanti Feeds, uh, first and foremost, you should see Avanti Feeds quarterly earnings growth, not quarterly earnings growth, the YOY EPS growth and YOY sales growth re-accelerating to at least 25% YOY for at least the next 2 quarters. Then you should also, I don't know what the return on equity is, but assuming that the return on equity is more than 22%, because it's a small cap stock, I think, or a mid cap stock. So at least more than 20% return on equity should be there. Assuming that is there, then what you should do is you should wait for a consolidation. And once that consolidation is broken with at least a 52-week high being made, so Avanti is not going to make an all-time high in a hurry. Okay. So hypothetically, so let's say Avanti suddenly starts showing good fundamentals, and on top of the good fundamentals, I want to see a very decent amount of price consolidation for a very decent amount of time, say for the next 3 to 6 months, not 3 months, say 6 months. Okay, so 6 months of time consolidation I need, and then I need a 52-week high. Okay, so in case of Avanti, obviously all-time highs will not happen in a hurry, so you might invest, like fine tune your timing to 52-week highs. 25% is the bare minimum EPS year on year growth you should see. But again, as I keep saying, more than the absolute numbers, the EPS growth should be stable or accelerating. Okay, so I hope I'm clear about Avanti, about the 52-week high. Okay, so in many stocks, sometimes you will not be able to buy them at an all-time high for a very long time. Okay, in such a case, you might make an exception if the fundamentals are exceptionally strong and if the stock has gone through an extended period of time and price consolidation and then it's breaking out over 52-week highs. For example, on the price chart, for example, this stock called that Adani Power, for example. So if you look at Adani Power, it is way below its all-time highs, but it has broken its 52-week highs, and that too with a bang. All right. And even in a bad market, it's able to sustain over the 52-week highs. Now, I don't know what the fundamentals of Adani Power are, or whatever the return on equity is, but let's say at this juncture, you also find that Adani Power fundamentals are very good and return on equity is very good. And you see that over the last 2 years, so Adani Power has been consolidating more or less for the last 2 years, 17, 18, around between 20 rupees and 45 rupees. Okay. And now it has broken up beyond that consolidation, made a 52-week high. And therefore, at this juncture, if the fundamentals are high, you can buy into Adani Power. Because if you wait for all-time high, that's a very, very long way away. Okay, so that's a long way away. Okay, so this is the exception. But here you have to be certain of two things: exceptionally good fundamentals, and the stock should have been consolidating for a long time. Okay. Amazon. Amazon had a PE of 150 and it was growing at 150%. Larsen and Toubro Infotech seems like a good stock fundamentally. Uh, I would buy it at all-time highs for sure. So Larsen and Toubro Infotech fundamentally is looking very good. Uh, it has technically looking very good, but I would buy it once it breaks. Once it breaks into, I'll buy it at 2,000 rupees plus. I'll buy it above 2,000. In fact, I will buy a lot of Larsen and Toubro. I mean, hypothetically, I would buy a lot of Larsen and Toubro Infotech above 2,000 rupees. Valueresearch.com is where you can see the fundamentals of all companies. Larsen and Toubro is very interesting. Larsen and Toubro Infotech, very interesting. But I will not buy it here. Even though it's made a very nice technical pattern, I will not buy it here. My funda is very simple. High quality stocks with high quality management when it is breaking all-time highs. And because the all-time high is not too far away, I'll wait for all-time highs. No rush. Permagen. Is that a stock? What is Permagen? I couldn't find anything called Permagen. Sorry. Permagen. I am not getting it in value research. Permanent magnets. Let's look at the quarterly results of permanent magnets. Okay, very good quarterly results. Fantastic operating margins. So the net margins is increasing. And let me look at the return on equity. It's a very small company. So it's a turnaround story. Okay. Okay. All right. It's a turnaround story. Return on equity is pretty nice, no doubt about that. It's a turnaround story. So let's look at the stock charts. So my friends, please look at permanent magnets on value research. Let's look at the chart of permanent magnets. Not getting the chart. It's only listed on BSE. Why are all these stocks only listed? There are so many stocks. That's very interesting. I've found many stocks which are exclusively listed in BSE. They're actually very high quality stocks. I don't know why. Is it some game or something? See, fundamentally, the stocks, as per the results, are looking very good. No doubt about that. What I would do out here is I would wait for the December quarterly results, which are going to come anytime soon. I'm going to take half, if whatever I'm planning to buy in permanent magnets, I will take half that position right now with a very strict, not right now, sorry, not right now. Please don't take a position right now. Once it makes an all-time high above 202 rupees. So if permanent magnets makes an all-time high above 202 rupees, I will buy that stock with a very strict stop loss of 175 rupees, because that looks like the midpoint of the consolidation band to me. Okay, and I would take that with a very strict stop loss. I will buy the stock at 202 rupees when it makes an all-time high on a at least a weekly closing basis. On a weekly closing basis, it needs to breach that high. It needs to make that high, and half I will take the position after I see the December quarterly results. So that would be my strategy in that would be a strategy in permanent magnets. The only problem with permanent magnets is because it's such a small stock, it goes circuit up, circuit down. So typically, I wouldn't ever invest in such a stocks because you know what, I can't execute my stop loss. See, I have no problems in buying even the smallest quantity or the smallest stock, but I hate when I'm not able to execute my stop loss. There is the biggest risk in permanent magnets. So there is a structural problem in permanent magnets. And also, when you're looking at a company like this, what will be very useful is if you look at the promoter shareholding. So my friends, go to bseindia.com, type permanent magnets, permanent magnets. Okay, and they bring the shareholding pattern of permanent magnets. I want to see what the promoter has been doing in permanent magnets. Okay, this is very important. So in June 2018, promoter holding was 71.81%. Good. In September 2018, promoter holding is 71.81%. March 2018, 71.81%. Okay, let's go back to June 2017, 71.81%. Okay, December 2016, 71.81%. Okay, so the promoter has not sold even a single share in his company. So who are the promoters here? Show the holding promoters. Promoters are Anil Kumar Taparia, 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 Taparia. Okay, the good news is the promoters have not been selling any of their shares in the company. Okay, so this is my strategy. I will buy into this company at all-time highs, and only if it is closing at all-time highs, and I will keep a strict watch on the price stop loss of 175 rupees, irrespective of how good the fundamentals are looking. And because it's such a small stock, I also want to monitor the promoter shareholding. So in order to monitor the promoter shareholding, it's very easy. What you need to do is, I will show you. So basically, all you need to do is uh, go to BSE website and type the name of the stock. And once you do that, you will on your screen you will get a tab called shareholding pattern. You click on that, you will get the shareholding pattern of each of the quarters. And once you go into that, so over here, for example, you will get the promoter group, what is the percentage of shareholding. And if you click on the promoter group, you will also get the name of the promoter and how much each promoter is holding. So this is very important to do when you are this is very important analysis when you're dealing with a fairly, micro cap kind of a situation, a stock with micro cap, unknown stock, unknown stock, yeah, AK. So as I said, ROE, return on equity, higher the ROE, higher the quality of the management. But more than I want to focus on the promoter holding percentage also, and make sure that when you're involved in micro caps, the moment you get a uh, get a quarterly shareholding report whereby the promoter has started selling, you immediately tighten your stop loss. This is the best advice I can give you. And as a homework, what I want every one of you to do is to do an analysis of PC Jewelers promoter shareholding from 2015 until the recent quarter, and send me your report on that. What do you think? What happened? Why is the report so ugly? So listen to me. Or the homework for today's class is, I want everybody of you to analyze the promoter shareholding of PC Jewelers from 2015 up till now and send me a report on that. Okay, Darshan, when I take up value investing next week, because Tata Steel is not a growth stock, it is a value stock, it's a cyclical stock, and cyclical stocks can only be handled by value investing. So I'll just give you a preview of what I'm going to teach you next week. So let us look at Tata Steel in valueresearch.com. Please, everybody do the homework. I want a report on the PC Jewelers shareholding pattern from 2015 up until now. Go to BSE website, find out the shareholding reports, quarterly shareholding reports, and tell me what do you think from 2015 up until now. So price to book value of Tata. Are bapre. Are bapre. Are bapre. Are bapre. Are bapre. Okay, Darshan, do you notice something very interesting? I don't know. I have not looked very closely at the numbers of Tata Steel, but there is something that is very interesting that has caught my eye. Okay, very interesting. Tata Steel BSL. BSL. What is BSL? Anyway, look at Tata Steel, everybody, on value research, and something has caught my eye. The price to earnings multiple of Tata Steel is 3.62. I'm repeating. The price to earnings multiple of Tata Steel is 3.62. I'm repeating again. The price to earnings multiple of Tata Steel is 3.62. Is it a time to buy Tata Steel or sell Tata Steel based on this singular data point? Please tell me, is it a time to buy Tata Steel or sell Tata Steel? If I just give you this one single data point, will you be looking to buy Tata Steel because it's trading at such cheap valuations, or would you be looking to sell Tata Steel? Especially for my old students who have been attending my classes, is it a buy or a sell Tata Steel? The only data point you have in front of you is Tata Steel price to earnings ratio trailing basis is 3.62. So I've got 4 buys. Any sells? Anybody wants to sell Tata Steel? Just based on this, I've not looked at the numbers, I've not looked at the price charts. Any sell? Amit Gupta is correct. It's a sell. Tata Steel is a sell. I will explain to you in the next class. Tata Steel is a sell. Based simply on this single fundament or single data point. There are so many data points you have to consider, but if somebody tells me that the Tata Steel price to earnings multiple is 3.62, or Vedanta's price to earnings multiple is 3, or JSW Steel's price to earnings multiple is 4, it's a sell. It's not a buy. It's a sell. All right. So if I look at Tata Steel BSL, I am seeing a massive increase in its operating profit, and I'm seeing a massive increase in its was the exceptional items. Yeah. So I'm seeing a massive increase in its operating profit year on year. But the problem is that this stock does not have that return on equity characteristics yet, because obviously it's been a loss making company. So you can't buy it based on a growth investing framework. Also, because its price to book value is 2.9, you can't buy it based on a value investing framework also. So there is no framework under which you can buy Tata BSL. The only framework which you can apply is the contrarian framework. So if you take an extreme contrarian view that BSL will do very, very well, uh, BSL is a may do very, very well on a contrarian basis, then you can buy it. But if you have listened to my growth investing framework, it obviously BSL does not fall into the growth investing framework because of the return on equity. And obviously, it does not fall into the value investing framework because of price to book value 2.9. So the only thing is contrarian. So you have to take an imaginative contrarian view in this. So basically, long story short, BSL should be less than 1. Price to book value should be less than 1. So you have to take a contrarian view and get into the stock if at all. So it's basically, to cut a long story short, the only way to buy and hold on to BSL is through technical analysis, not fundamentals. But what I want you to do is think why Tata Steel is a sell. I want all of you to think why Tata Steel is a sell. And if you can come up with the right answer, or if you disagree with me, send me an email. With this, I will end this class. Thank you. Bye bye.